Good day, my friends. Let's learn something new today.
Okay, we are going to be looking into something that's very interesting, and that is, of course, interest rates and things like that, and how to make your money grow. As you can see, simple interest, make your money grow. Wow. Hi there. Ready to learn how your money can grow? Today we are diving into simple interest, a magic spell that makes your money multiply. Now guys, this is not it can make your money multiply, but it's going to take a very long time, because normally, let's say you just put it into a bank, onto a savings account, into a bank, you will only be earning maybe, let's say, 5% or 7% per year annum, and your inflation rate could be 10% or more. So in actual fact, you're busy losing money. You are not busy multiplying your money. But anyhow, let's continue with the lesson, and we see where we get to. Righto. What is the next one? Let's see. Oh, and of course, man, it's By Myself by Alfred Grobler. I almost forgot all about that. Righto. Simple interest, the basics. Let's look at the basics of simple easy. Easy calculation. Of course, it's very easy to calculate it. Simple interest, to understand and calculate how much money you'll earn over time. It's so easy to calculate it, guys, really. Consistent growth, of course, is have a consistent growth if you just put it on an investment into a bank. As long as the bank is open and doesn't go bankrupt, you'll always be getting your money every year. Earn interest on the original amount each year, like a steady stream of income. That is the thing I don't like about simple interest, because it works on your original amount of principal amount that you have placed into the account. And that's one thing that I just don't like about it, guys. Righto, with that said, let's move. Okay, let's continue, and we will be looking at, well, money coming in all the time, huh? An example of a savings account, right? Firstly, year one, you're going to be deposit, let's just say we take $100 for instance. They'll be paying you, let's say, 5% interest, so your total balance will be $105 after the first year, because you get 5% interest on that $100. Now let's go to year two, and we see what happens. Year two, right? You'll still be earning 5% on the original $100, and it'll give you a total now of $110. It's $5 for that year, $5 for this year, and that gives you $10 total that you'll be earning. Where if it was compound interest, this year this original amount would turn to 105. So you're getting 5% on 105 instead of just on 100. That is why compound interest is a lot better, but there's only a very few places that do pay compound interest. Righto, let's have a look at the next section. Simple interest formula. Interest, the amount of money earned or owed, right? It's the amount of money you've owned or that you've earned or whatever. The principal amount is the original amount of money invested or borrowed. The rate, of course, that is the rate from the company or wherever you are borrowing the money from, and the rate is normally calculated on a yearly basis. Righto. And then, of course, time is the length of time the money is invested or borrowed, usually in years, right? It normally works in years because there's a very few places where you'll be borrowing money and paying, let's say, 5% per week or per month or whatever the case might be, right? But normally it is in years, right? And of course the formula is interest equals the principal loan amount times interest rate times time. And there it is, more or less. Interest equals P times R times T. Right, guys, that's the formula that we'll be using all the way along. I hope you understand it, because you're going to be needing it. Okay, let's have a look at an example, right, of a simple interest. Right, simple interest in real life. Wow, let's go and have a look at it. Savings accounts, number one. Banks pay your interest on your deposits. Another one, loans, money that you are borrowing from a bank, a credit card, somebody else maybe. There are many things for different purposes, buying a car, buying a house, starting up a business, whatever the case might be. There could be many reasons for you wanting to borrow money or loan money. Investments, that's where you're investing money into, I don't know, let's say into fixed deposits in banks or wherever you could be depositing your money into. Right, and now let's just move on. For instance, now we're going to be looking at an example. You have had a very good year, whatever you were doing, and you have decided to go and buy yourself a brand new electric car, sports car on top of everything, hey? Wow. So let's have a look at it. A car loan. Let's say you're paying $20,000 for the car. The principal amount is the amount that you've borrowed, right? And then of course the interest rate is 7% in this case over here, right? The percent charged annually, please note annually, right, is important. And then of course the period or the time over which you're borrowing this money over here or paying it back. So let's go and have a look at the formula. That means a loan term in years, right? Okay, don't forget that it's in years, eh? As I said to you, the time or the period over which you'll be paying it back. Let's go and have a look at it. Wow, it works out to $7,000, right? Because you take the total interest, right? You've got your formula over here. That is your principal amount times your interest rate, right? Remember, it won't just be the 7. You must first convert this, divide it by 100 to get it to a decimal, multiplied by the 5, and you'll get $7,000. That is your total commission for this one over here. Great, guys. I think with that said, let's move on. Okay, it is now time for you to practice what you have learned so far in this lesson. So the first one is going to be, let's see, problem number 1. That's about what? You've deposited $500 into a bank or wherever the case might be at a 3% interest rate, and the period is 4 years, and the question is, how much interest did you earn? The second one, what is this? What could this be? Problem number 2. You borrow $1,000 by somewhere, a business, a bank, whatever the case might be, at 2% interest, and your repayment period is 3 years. How much money is owed after the 3 years? Well, you have paid back, right? Because normally you don't just borrow it and pay it back after 3 years. You normally pay a monthly installment. So how much will you have owed or paid back on this over here? Guys, I think at this point of time, it's a good idea to pause the video and solve the solutions, do the solutions to these two problems over here. And once you've got the solution to these two problems here, you can continue with the video and watch the rest of the video to see your solutions.
Hey, you must pause the video.
Okay, I assume that you have solved your problems and you're honest about it. So let's have a look at the solution. Solution number 1. Of course, our formula, our interest, or what we'll be paying, is our principal amount times the rate times the period. So the principal amount is the $500, which is given over there. The 3% is the same as 3 divided by 100, and then we multiply it by the period or the time of it, and it gives us a total of $60 that you would have earned on your money. Let's go and have a look at this one over here. Righto. Solution number 2. Also, there's the formula. You have borrowed 1,000, and then you divide it by also 2 divided by 100, multiplied by the period you'll be borrowing. So the interest you'll be paying back here is $60. And of course, the total amount of money that you'll be paying back is your principal amount plus the $60 interest. So it's $1,060 that you'll be paying back in total. Guys, I hope you understand that. If you don't understand it, please, guys, if you had a mistake when your answers didn't agree, your solutions didn't agree with what I'm showing over here, please watch the video once again to make sure you understand it, because these are basic business principles which can help you a lot in your life forward. Good. As we are now getting to the end of this lesson, let's have a look at the key takeaways of this lesson, or things that we have learnt. So have a look at it. Interest on original, that's the simple interest, is calculated on the original amount, not the growing balance. That's the big difference of it between simple interest and compounding interest. The second thing, it is easy to calculate. Yes, this one is much easier to calculate than what compound interest is, right? There's your basic formula, your principal amount times the rate times the time to find the total interest earned. And then of course, real world applications where you can be seeing, or where your experiences here. Simple interest is actually everywhere. Understand it to manage your finances. Guys, simple interest is almost everywhere. If you go and buy to a shop, and you go and buy, let's say, a TV over a period of time, this is the way that your interest will be working. Really, guys, you'll run into this simple interest virtually everywhere, and I think you're going to be doing it a lot of times in your life. But unfortunately for AI that's coming up, and the crypto world and the blockchain, I can tell you, I think all this year is going to be changing in the very near future.